A Roth IRA is one of your most important accounts in retirement. It's a tax-free account that can be used in a lot of strategic ways. However, if you're not careful, you can actually make this tax-free account taxable and potentially even owe additional penalties on withdrawals that you make from this account. In today's video, I want to provide clarity on some often confusing and misinterpreted rules around your Roth IRA. With most of this video, I want to dig into some of those confusing Roth rules. But beforehand, there are some simple and easily avoided Roth penalties that you should be aware of first. The first rule is the 59.5 age rule. This rule slightly differs from the 59.5 age rule that governs traditional IRAs, in that you can pull contributions you've made before 59.5 from a Roth IRA. You just can't pull any earnings. The next penalty is one that you might see if you over-contribute to a Roth IRA. Say you forgot you made a contribution earlier in the year, and because of this, you basically doubled up on your Roth contribution. You will need to reverse this contribution or see a 6% penalty per year on the amount that you over-contributed. Then we have something called prohibited transactions. This is by far the worst penalty someone can see on their Roth IRA, but happens when you do things you're not supposed to do within your Roth. Like, let's say, borrowing money from it or buying life insurance with it. Breaking this penalty means your Roth account loses its Roth status and can potentially be 100% taxable. Now, before we get into any of the more complex rules, it's important to start with something called Roth ordering rules. Anytime you make a withdrawal from your Roth IRA, these Roth ordering rules ultimately determine if you will have a penalty or owe any amount of taxes. Let's talk through these ordering rules, and then I'll give you a few examples for why these rules really matter. Anytime you take a Roth distribution, the first dollars you pull out from that account are going to be contributions first. Once you pull out all of the contribution dollars, the next amount you will pull will be dollars from any previous Roth conversions that you've made. Then finally, earnings are pulled very last. On the right-hand side of the screen, I have a sample composition for a $115,000 Roth IRA. Now, let's go through a few examples and show why these Roth ordering rules are important to keep in mind. Say we have an individual that was going to pull $25,000 from their Roth for some life event. Will this individual have any taxes or penalties for this withdrawal? One might think we need more information about this individual. Are they over 59.5? How long have they had their Roth IRA for? We actually don't need any of this information. Contributions from a Roth IRA can always be withdrawn tax and penalty free. So it doesn't matter if this individual is 30 years old or 60. This would be a non-penalty, non-tax situation. Let's say they were going to take quite a bit more from their Roth, $70,000 in this situation. Here they would pull all of the contributions first, and next they would pull $35,000 from previous Roth conversions. Here we would need some additional information. How old is this individual? How long ago did they perform said Roth conversions? Now, I'm getting a little ahead of myself, and so let's explain some of the rules around Roths that you need to be aware of, and then we'll come back to this. Rule number one, the 5-year aging rule. This is a rule that only applies once per individual. Once it's met, you never have to worry about it again, regardless of how many Roth IRAs you have. This rule states at least 5 years must elapse between the beginning of the tax year of your first contribution to a Roth account and the withdrawal of earnings. If you break this rule, you will not owe penalties per se, but you will owe taxes on whatever portion of earnings that are part of that distribution. Now again, this is a lifetime rule that many of you watching this video are probably already past. But again, this rule states when you open and fund your first Roth IRA, you cannot pull any earnings from that Roth until 5 years have passed. So if 2025 is the start of your first Roth, then you cannot pull earnings tax-free until 2030. It's important to note that reaching age 59.5 is irrelevant for this rule. Now, I find that this rule is often worried about, but rarely ends up being in play for many individuals. Reason number one, the Roth ordering rules. Earnings are the very last thing to be distributed from your Roth. Reason number two, many individuals start Roth IRAs, as I mentioned before, well before 59.5 when earnings can't be withdrawn anyway. By the time they reach 59.5, they've surpassed this 5-year lifetime rule. Let's say you were in a situation, however, where you've earned too much income over the years to be able to contribute to a Roth IRA and start that 5-year clock. With our clients, we use a very simple workaround. We convert $1 from a traditional IRA to a Roth IRA. Because it's only $1, we don't really have to worry about if that Roth conversion makes tax sense. But converting this dollar allows us to start that 5-year clock. The second major Roth rule is also a 5-year rule, and I find this to be one of the rules that is most often misinterpreted. This rule seems quite simple. If younger than 59.5, each Roth conversion starts an individual 5-year clock. Any converted amount cannot be touched until 5 years has passed. If you break this rule and distribute the converted amount before 5 years is over, you will have a 10% penalty. In my experience, the confusing part for most individuals is around the 59.5 age qualifier for this rule. Let's go through this rule with a few examples. Let's take an individual who is performing a Roth conversion at age 50. The full 5-year conversion rule would apply in this situation. Now, anytime a conversion is made, regardless of the time of the year, the clock starts at the beginning of that tax year. So in this situation, this individual would be able to withdraw that conversion penalty-free starting in the year they turn 55. Let's say this individual was performing a conversion at age 57 instead. Here, the 5-year conversion rule turns into more of a 2.5-year-ish conversion rule. Remember, the most important qualifier for this conversion rule is whether the individual is older than 59.5. As soon as they reach age 59.5, no conversion 5-year time frame applies anymore. Then finally, we look at a conversion situation for an individual age 60. Here they can perform a Roth conversion and have it immediately accessible. There's no waiting period. You can even withdraw part of that conversion in the same year. I see this rule mixed up all the time, but just to be as clear as possible, if you are over age 59.5, the 5-year conversion rule does not apply to you. The 5-year aging rule may still apply to your earnings, but the conversion rule will not. Now, going back to the previous Roth ordering rule example, will an individual taking this $70,000 distribution owe any tax or penalties? As mentioned before, the first $35,000 will be tax and penalty free regardless. But what about the next $35,000? Well, if this individual is over age 59.5, they are in the clear. If they are younger than 59.5, we need to know how long ago they originally did the conversion. Now, this could be one or multiple conversions. If multiple conversions, then each conversion will have that separate 5-year clock that we will need to factor in here. And then again, as I mentioned before, because earnings are withdrawn last based on these Roth ordering rules, in my experience, rarely does the 5-year lifetime rule come into play. In this scenario, they would need to withdraw more than $85,000 for this rule to even matter. Then the final rule that may cause retirees to owe unexpected penalties is one related to inherited Roth IRAs. This is a rule that has changed in recent years, but forces inherited Roth IRAs to have a required minimum distribution. If you inherit a Roth IRA from someone who passed away after January 1st, 2020, that inherited Roth IRA is subject to something called the 10-year rule. For inherited Roths, this rule is quite simple. In the year after the original owner passes, a 10-year countdown begins. During this 10-year period, you will not have any annual RMDs, but at the end of the 10th year, you will need to have fully withdrawn the entire inherited Roth balance. Now, the good news is there are no taxes owed on this distribution. The bad news is if you forget to fully withdraw the inherited Roth, you could have as much as a 25% penalty on the amount remaining in the Roth, which can be quite expensive. With our clients, if you don't have an immediate need for that money within this inherited Roth, we recommend leaving that money in for the entire 10-year period. The main reason for this is that it will maintain its Roth status for those 10 years, allowing for tax-free growth. Yes, eventually it needs to be emptied, but because all distributions are tax-free, we want that extra growth while we still can. I hope this helped clear up some confusion around Roth penalties. If you're someone who is saving for retirement and wondering what is the best decision for your situation, contributing to a Roth IRA or contributing to a traditional IRA, click on this video right here, where we break down the most important variable in this decision-making process. Click here to learn more, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.